Thank you for joining me for this weekly market update. I want to take a look at the year ahead, and I'm just going to tell you up front, I'm supporting with data a very bullish outlook for the year. Tax reform is a game changer. It's going to raise earnings, it's going to raise consumer spending, it's going to change the economy, at least in the short term. And these are bullish factors. Now, I'll run through the exact numbers with you so that you can see why I believe stocks could gain 40% over the next 12 months. Now, this will end. This bull market will end, and I believe it's going to be the Fed that ends it. Inflation should start picking up this year. I think the Fed's going to go into a panic mode when that happens, raise rates too quickly, and choke off both the bull market and the economic expansion. So that's what I'm looking for in a nutshell. Earnings are growing. That's one reason I think we should be bullish. Earnings growth right now projected to be 11.8% next year. Sales growth up 5.6%. I think what we're going to see is revisions to this to the upside, and that's going to push and accelerate gains in the market. So earnings and sales look good. Profit margins are at record highs. This gives companies a lot of room. They can take steps when profits are high that they can't take when they're low. Now, everyone's looking for share buybacks. I don't think that's going to be the primary use of cash, though. I think companies are going to be incentivized under the tax plan to increase salaries, and we're already seeing that with a number of companies paying out $1,000 bonuses at the end of 2017 and agreeing to raise wages to at least $15 an hour in many cases. So we've spent years as a country debating minimum wages. All of a sudden, a tax plan comes through and companies on their own agree to raise wages. This is significant. And I think we're going to see it play out over the next year, over and over again in bullish news from companies. I don't think we'll see profit margins come in this high at the end of the year, because I think we're going to see labor costs voluntarily move higher, and that will reduce profit margins, but it will increase consumer spending. For now, the S&P Standard & Poor's estimate for the S&P 500 is $145.31 in earnings per share. Using PE ratios of 20, 26, and 32, those are my targets. Now, you might be wondering why I would use such high earnings or high PE ratios. And the reason is because central banks determine what the PE ratio should be indirectly. They do this with their interest rate policy. And this chart goes back to the beginning of the Federal Reserve. And what we see is initially the Fed wasn't a strong body, and we had a great deal of volatility. We had frequent recessions. We had problems in the economy. Eventually, the board reached the structure where what we have now, the FOMC, the Federal Open Market Committee, becomes stronger than the regional banks. We had the gold standard. We had Bretton Woods, which set international exchange rates. We had a number of factors that kind of stabilized the economy and the markets. And that's what we see here in the Shiller-Cape ratios, cyclically adjusted PE ratios. That all fell apart, and it fell apart suddenly, and we see that in the market sell-off that occurred in the early 70s. This was when Nixon abandoned the gold standard. We had high inflation, and central banks began searching for new tools. They lost the gold standard in Bretton Woods. This was a transition period. What they came up with was inflation targeting. And since then, we have seen a dramatic shift in market valuation. That's justified. If the Fed and other central banks are constantly going to be targeting inflation, then we should have higher stock prices. In the early 1900s, deflation almost seemed to be the goal. We had lower prices. We had a bubble, and we'll have bubbles again. But everything's at what looks to be a higher level, until the Federal Reserve changes its policy regime. Now, can stocks really gain 40% this year? Well, first of all, I want you to remember, expect pullbacks along the way. But I also want you to remember this bull market is not as old as you're seeing in most of the major media reports. I define a bear market with these terms. And if you recall, this definition catches two additional bear markets. If you recall that late 2015, early 2016 timeframe, markets only fell 14.5%, but it was a bad time to be an investor. Markets really struggled. This definition catches that. So this definition truly tells us when we're in a bear market, when we're in a bull market. Under this definition, this is a relatively average, below average bull market. We have about 5 months on average to run. We have 20-some percentage points to run to be average. So we have some additional upside here just based on the numbers. Current market environment remains bullish. Here's a look at breadth. I know we haven't seen these charts in a little while, but here's breadth, still strong, 76.2%. Small cap chart. What we're seeing here is it looks to be a little bit of consolidation, but as we know, consolidations can replace bear markets. So as long as we hold support, the bull market is intact. This chart looks bullish. Now, I also expect seasonal trends to drive sharp gains. And I believe seasonal trends are an important factor here because I think a lot of investors are underinvested based on seasonal trends. A lot of hedge funds do look at seasonal trends, and this goes back all the way to 1900. It shows January, one of the strongest months of the year. But over the past 10 years, January has not been one of the strongest months. It's been the weakest month. I believe the reason for that is this covers the last 10 years, going back to 2008. I think when historians look at this time period, they're going to call it the dark times. The mood has been very dark over the last 10 years. Maybe politics drives it, maybe social issues drive it, doesn't matter. We have a darkish mood here that I think tax reform lifts. And I think we revert back to the older patterns that we've seen prior to the past 10 years. That's bullish from a seasonal perspective. So we have good seasonals, we have good technicals, we have great fundamentals, we have tax reform. I expect a rally in January, I expect a rally in 2018, and I expect this to be a great market for trading. That's all I have for today. Thank you.